Hi, welcome to the Introduction to Finance. We'll first start by understanding the meaning of finance. So, the term finance originates from the French word finir, which means to end or to pay. Now, to end in this context means to settle a dispute or a debt that is due. Now, finance to a layman might just mean money, but it's important to understand that in the wider concept, it also refers to the flow of money. Now, specifically, finance deals with the questions of how an individual, company, or government would acquire money and how they would spend or invest that money. So, in simple terms, it is just money management. Coming to money versus finance. Finance is the management of money and other assets. Money, as we know, is just a medium of exchange, whereas finance is the source and application of this money. Accounting versus finance. So, accounting focuses on the day-to-day flow of money in and out of a company or an institution, whereas finance is a broader term for the management of assets and liabilities and the planning for future growth. Now, it's one thing to remember is that both of these are very much interrelated. This is because we need the accuracy of accounting data to make future plans for our company, which comes under the financial decisions. Coming to the meaning of financial management. So I hope you all have heard of the popular saying, one needs money to make money. Financial management is that managerial activity which is concerned with acquiring, financing, and managing assets to accomplish the overall goal of a business enterprise, which is mainly to maximize the shareholders' wealth. So, in simple terms, financial management is the effective and efficient utilization of financial resources. Now, there are two key objectives. Number one, profit maximization. And number two, ensuring that our shareholders get good returns on their investments, which is known as ROI. The difference between finance and financial management is, as we know, finance is just the source and application. But under financial management, we would have planning, organizing, and directing these resources. Now, main activities of a business. There are three main activities in any business: operating, investing, and financing. Operating activities are the principal revenue producing activities from the core activities. Okay, so that is buying and selling of goods, providing services, etc. So let's take an example of a company that is making refrigerators. This company would purchase raw materials, build inventory, and would advertise their product. Now, investing activities is the acquisition and disposal of the long-term assets such as investments and property, plant and equipment. Financing activities are activities that include the inflow and outflow of cash between investors and the company. Hi, let's now look at the difference between the calendar year, financial or fiscal year, and the assessment year. Starting with the calendar year, it is the 1 year period that begins on January 1st and ends on December 31st. This is based on the commonly used Gregorian calendar, as we all know. Next is the financial year. The balance sheet and the income statement of companies across the globe are usually prepared for a period of 1 year. However, the date from which this period starts varies from country to country. In America, this 1 year period starts from 1st October and ends on 30th September of the next year. The financial year of UK starts on 6th April and ends on 5th April of the next year. The period in which the income is earned is known as the financial or fiscal year. Assessment year. The next year in which the income tax is assessed is called the assessment year. Here's an example. Let's say the financial year was from 2015 to 16. Your assessment year for this period would be 2016-17. Similarly, if your financial year was 2016-17, your assessment year would be 2017-2018. Thank you. Hi, we will now look at the various forms of enterprises. But first, we will start by understanding what an enterprise is. An enterprise is simply an organization that is created for business venture. Examples include IT companies like Amazon, retail stores that could be big or small, like Walmart, and banks such as the Royal Bank of Scotland. Coming to the various types of enterprises, we have three main types: the sole proprietorship, partnership, and a company. The partnership can be further divided into the general partnership firm and a limited liability partnership, also known as an LLP. Company has five different types: an OPC or a one person company, private company, public company, government owned, and a not for profit. Let's look at each one of them in more detail. Starting with a sole proprietorship, it is owned by a single person. It is the simplest form of business ownership and is owned, managed, and controlled by an individual. This individual is the recipient of all profits and bearer of all risks. There is no legal distinction made between the owner and the business entity. What this means is one's home, bank accounts, cars, and other assets can be seized to satisfy the claims made by creditors if the business hits a rough patch financially. Now, there is no need to get consensus before making decisions about the business. It's all yours. Examples include beauty parlors, hair salons, small scale activities like running a retail shop in the locality, or even small businesses. Profits from sole proprietorship pass through the owner's personal income. This means the taxes are simplified. Sole proprietorships generally have a harder time accessing loans and investment capital than other business ownership types. Moving on, we now look at partnership. A partnership is a business that is owned by two or more people, known as partners. The general partnership firm is an association of two or more individuals that carry out as co-owners of a business. All partners have unlimited liability. That means that every partner's personal assets can be used to repay the liabilities of the partnership. This is similar to sole proprietorship. Here, this also means that each partner is responsible for the actions of other partner. Let's take an example. Let's say A and B are in a general partnership. If A is sued for a malpractice, B's personal assets will also be claimed against in the lawsuit. It is usually founded on formal partnership agreements such as partnership deeds that outline the ownership share, rights, and obligations of each partner. Coming to limited liability partnership, it is also similar to the general partnership firm. But it's important to note that the partners here are not responsible for the actions of other partners or the debts of the business. Each partner's liabilities are limited to the amount that they put into this business, and hence this behaves as general partnership and a company. Next, we have a company. The company's legal status is independent of its members. What this means is that a risk that any person takes by investing personal money in a company is restricted to the amount of his or her investment in that company. The creditors and lenders of a company cannot force their members to pay debts due to them by the company out of the members' personal funds. But it requires comparatively more paperwork than other enterprises. The profits generated by the corporation are taxed as personal income of the company. Then, any income distributed to the shareholders as profits, also known as dividends, are taxed again as personal income of the owners. Coming to the types, we start with a one-person company or an OPC. As the name suggests, it has only one person as its member. Such companies are generally created when there is only a sole owner of the business. A private company must have at least two shareholders. It can issue stock, but their shares are not traded on public exchanges. Public companies are allowed to sell the shares to the public, and the ownership is dispensed to the general public shareholders through the trade of shares. To enable them to go public and list their shares on the stock exchange, they must satisfy strict criteria which is laid down by the law covering the publication of financial status. Government-owned companies or corporations such as the British Broadcasting Corporation or BBC are organizations owned by the government. They are funded in various ways including government grants and subsidies, license fees, and charges for supplying their service. Not for profit are not established to make a profit, but they may earn revenue and run on the commercial lines. How do you know what enterprise to choose? Every business structure poses different benefits and limitations. To find out the best option for your situation, you'll have to answer a few fundamental questions about your business. An example is, how big is your business now and what are your business development plans? The main considerations when choosing a structure for your business are simplicity, liability, control, getting finance from outside, and taxes. Coming to examples, many businesses begin as sole proprietorships, as this type of a business is great for new or small businesses. As they grow and expand, many businesses tend to convert to other structures. eBay is a very famous example that started as a sole proprietorship. HP is an example of an incredibly successful and famous partnership. Apple is listed on the stock exchange and hence is a public company. It has continued to exist despite one of its co-founders, Steve Jobs, passing away. The term startup has been gaining a lot of popularity recently. Let us dig in and see what this is. A startup is an entrepreneurial venture which is typically an emerging, fast-growing business that aims to solve an unmet need by developing a viable business model around the innovative products or services. The exact criteria might vary from country to country, and accordingly, a few countries give various subsidies to these startups. Examples include Uber, Instagram, LinkedIn, Netflix, SpaceX, etc. A startup can be registered as any type of a legal entity. Thank you. Hi, so next we'll be talking about the branches of finance. Finance can be personal, corporate, and public. Let's look at each of them in more detail. Starting with personal finance. Personal finance generally involves analyzing an individual's or a family's current financial position. This is done by predicting short-term and long-term needs of the family and executing a plan to fulfill those needs within an individual's financial constraints. This can be done by creating a budget. Personal finance depends largely on one's earnings, living requirements, and individual goals and desires. Next, we have corporate finance. It is the area of finance that deals with the sources of funding, the actions that managers take to increase the value of the firm to shareholders, and the tools and analysis used to allocate financial resources. Lastly is public finance. It deals with the income and expenditure of government entity at any level. That can be central, state, or local. However, in the modern day context, public finance has a wider scope. It studies the impact of the government policies and the budgets on the economy. This is looking at finance at a more macro level. Thank you. Hi, let's now discuss some basic banking terms. Starting with the reserve ratio. This is the portion of deposits that a bank must hold on to rather than lending out. Now, this minimum requirement is set by the central bank of a country. So, let's say if a bank has $500 million in deposits and the Federal Reserve's requirement is of 10%, then the bank must keep at least $50 million in reserve. Next is a collateral. This is a security that is provided to the bank in exchange for a loan. This can be in the form of gold, land, house, etc. Fixed rate and floating rate. A fixed rate is when the rate of interest for a loan remains constant throughout its entire tenure. When this rate changes with time, it is called as floating rate. Credit score or rating. So it is a number that indicates the creditworthiness of an individual. Now, the higher the score, the better a borrower looks to the potential lenders. HNI or high net individuals is a term that is used to designate people whose investable wealth exceeds the given amount. For example, clients with investments greater than $1 million US. NPAs, non-performing assets. It is a classification for loans and advances that are in default or in arrears. Now, a loan is in default when the lender considers the loan agreement to be broken and the debtor is unable to meet his or her obligations. A loan is in arrears when the principal or the interest payments are late or missed. Lastly, we have KYC, also known as Know Your Customer. This is an effort made to verify the identity, suitability, and the risks involved in a business relationship. This includes ID card verification, face verification, document verification, and this is done to limit fraud. Thank you. Hi, we will now look at types of accounts. We'll be covering a few common types. Starting with a savings account, as the name suggests, it is an account opened with the aim to save money. They provide modest interest rates on their deposit. Next, we have a current or a checking account. They are mostly business accounts where the money is frequently transferred between the financial accounts. These accounts are best suited for transactions by the corporations and business owners for their daily activities. Next, we have a recurring deposit account. In case of a recurring deposit account, the deposits are made by the account holder at regular intervals for a specified time period. The banks then pay the relevant rate of interest when the amount is repaid after the fixed time period. Lastly, we have a fixed deposit account. Now, these accounts are open to earn interest on lump sum deposits for a fixed period of time until their maturity. Fixed deposits are among the safest financial instruments to save and earn interest on idle money. Thank you. Hi, have you ever wondered how banks make money? Let's take a quick look on how they do so. Banks give loan to individuals and enterprises, and they charge interest to them. Now, the interest that they charge on these loans is more than the interest that they give to depositors, and this difference between the interest rates is what banks earn. Their other sources of revenue include fees that they charge on overdraft, credit card, ATM withdrawal, late payment, minimum balance, and wire transfer. Here, overdraft is the advance that is given up to an agreeable limit for a short period, and so the banks charge fee for this. Wire transfer is charged when the funds are transferred electronically. They are charged so the money is transferred safely and securely across long geographical distances. Thank you. Hi, we will now be talking about the various aspects under banks and the banking system. Let's first begin by understanding their benefits. We have four main benefits. Number one is safety. It is safe and easy for us to park our funds with them. Next, we have convenience. It is very convenient for us to withdraw our funds from almost anywhere. Next is earning interest. When we park our funds with the banks, it helps us earn interest. And lastly, we have borrowing money. Banks give out loans and advances to the people in need. Thank you. Hi, let us now look at the difference between the cash and the accrual basis of accounting. The difference between the cash and the accrual accounting lies in the timing of when the sales and the purchases are recorded in your accounts. Cash accounting recognizes revenue and expenses only when the money changes hands, but accrual accounting recognizes revenue when it's earned and expenses when they are billed but not paid. That is, cash accounting shows the actual, whereas accrual accounting shows the assumed. Cash basis accounting. The cash basis of accounting recognizes revenues when cash is received and expenses when they are paid. Many small businesses opt to use the cash basis of accounting because it is simple to maintain. It's easy to determine when a transaction has occurred, the money is in the bank or out of the bank, and there is no need to track accounts receivables or accounts payables. Accounts receivables represent money that your customers owe you, that is, what you have earned but yet to receive. Accounts payable, on the other hand, represent the money that you owe to the other entity, that is, what you have to pay them. The cash method is also beneficial in terms of tracking how much cash the business actually has at any given time. So, you can just look at your bank balance and understand the exact resources at your disposal. Also, since transactions aren't recorded until the cash is received or paid, the business income isn't taxed until it's in the bank. Now, coming to accrual basis accounting. Accrual accounting is a method of accounting where the revenues and the expenses are recorded when they are earned, regardless of when the money is actually received or paid. For example, you would record revenue when a project is complete rather than when you get paid. This method is more commonly used than the cash method. The upside is that the accrual basis gives us a more realistic idea of the income and the expenses during a period of time, therefore, providing a long term picture of the business that cash accounting cannot provide. The downside is that the accrual accounting doesn't provide any awareness of the cash flow. A business can appear to be very profitable, while in reality it might have empty bank accounts. Accrual basis accounting without careful monitoring of the cash flow can have potentially devastating consequences. Let's see an example. Imagine you perform the following transactions in a month of business. Number 1. You sent out an invoice for $5,000 for a web design project that you completed this month. Number 2. You received a bill for $1,000 in developer fees for the work done this month. Number 3. You paid $75 in fees for a bill you received last month. And number 4. You received $1,000 from a client for a project that was invoiced last month. How do you think the cash and the accrual accounting would affect the profits in this month? Let's see. Using the cash basis method, profit for this month would be $925. That is the $1,000 that you received minus the $75 that you paid. Using the accrual method, the profit for this month would be $4,000. That is the $5,000 that you sent out an invoice for and the $1,000 that you paid in developer fees. Note that we are not taking the $75 and the $1,000 in the accrual method because they were accounted for in the last month. This example displays how appearance of the income stream and the cash flow can be affected by the accounting process that is used. Let's look at how these affect the taxes. Using the cash basis accounting, income is recorded when you receive it, whereas with the accrual method, the income is recorded when you earn it. Following the above example using the accrual accounting, if you invoice a client $5,000 in December of 2017, you would record that transaction as a part of your 2017 income and thus pay taxes on it, even if you end up receiving the payment in January of 2018. If this was under the cash basis method, this income tax would come under the 2018 bracket. Let's look at the difference between the two in more brief. Cash accounting recognizes revenues when the cash has been received. Accrual accounting recognizes revenue when it's earned. Examples are when a project is complete and invoice is shared. The cash accounting recognizes expenses when the cash has been spent. The accrual accounting recognizes expenses when you are billed, that is, when you have received the invoice. Under cash accounting, the taxes are not paid on the money what hasn't been received yet. Whereas under accrual accounting, the taxes are paid for which you have shown transactions. The cash accounting is mostly used by small businesses, whereas the accrual accounting is mostly used by medium and big companies. It's also important to check the rules in your country. Thank you. Hi, let us now look at an overview of the financial statements. So what are financial statements? Financial statements, also called financial reports, are the formal records that show the financial activities and the performance of a business, person, or other entity. To maintain consistency and ease of understanding, standardization accounting standards are followed. The four common types of financial statements are balance sheet, income statement, cash flow statement, and the statement of equity. Let's look at them in more detail. Balance sheet is a financial statement that provides the details of the company's assets and their sources of funds at a certain point of time. The examples of assets are machinery, inventory, etc. In the sources of funds, it can take from owners' money or as liabilities, which are obligations from the outside of the company. Examples of liabilities are bank loans. Income statement, also referred to as the profit and loss report or the P&L report, is a statement that shows the financial performance of a company, that is, the profit earned or the loss incurred during the accounting period. Most companies issue annual income statement, but quarterly and semi-annual income statements are also quite common. They report the income, expenditure, and profits over the stated period. Cash flow statement is a statement showing the inflow and the outflow of cash and cash equivalents during an accounting period. Cash equivalents are short-term, highly liquid investments that are readily convertible to known amounts of cash, which are subject to an insignificant risk of changes in value, such as bank deposits, very easily convertible assets, and cash equivalents with the short-term maturities, which is less than 3 months. Many a times, business would say they would pay, but they don't. This gives a better clarity of the reality. Coming to the statement of equity, it basically reports the changes in equity or ownership of the company over a stated period. Combined, these statements, that is the balance sheet, income statement, cash flow statement, and the statement of equity, provide good view of the financial health of your business. Although the statement of equity isn't very common. For large corporations, these statements may be complex and may include an extensive set of footnotes to the financial statements for management decision and analysis. Now coming to the recap, a balance sheet is your status of business assets, liabilities, and equity at a point of time. Income statement is your business's profit and losses during the period of time. A cash flow statement is your business's incoming and outgoing of cash and cash equivalents, whereas a statement of equity is basically the change in ownerships. Coming to the objectives of the financial statements. These statements show an accurate state of business entities' economic assets and liabilities. External stakeholders like the investors and authorities generally do not possess this information otherwise. They help in predicting the extent of a company's capacity to earn profits. Shareholders and investors can use this data to make their financial decisions. These statements depict the effectiveness of a company's management. How well a company is performing depends on its profitability, which is what these statements show. These statements also provide information relating to the company's cash flows. Investors and creditors can use this data to predict the company's liquidity and cash requirements. Thank you. Hi, let's now look at the key activities of a business. There are 3 types of key activities in any business. We first have the operating activities. These are the principal revenue producing activities of the enterprise, like buying and selling of goods, providing services, etc. This could include purchasing raw materials, building inventory, advertising, and even shipping the product. Now, we have investing activities. These are the acquisition and disposal of the long-term assets such as in property, plant, and equipment. Financing activities are the activities which include the inflows and the outflows of the cash between the investors and the company. Let's look at each of them in more detail. Operating activities. Like said before, these are the principal revenue producing activities of the enterprise. Examples include payments to suppliers for goods and services, payments to the employees or on behalf of the employees such as social benefits, and purchase of merchandise. Investing activities. These are the acquisition and disposal of the long-term assets such as in property, plant, and equipment. Examples include purchase or sale of an asset, loans made to suppliers, and payments related to mergers and acquisitions. Financing activities. Now, these include the inflows and the outflows of the cash between the investors and the company. Cash flow from financing activities are activities that result in changes in the size and the composition of the equity capital or the borrowings of the entity. Examples include dividends paid, sale or repurchase of a company's stock, net borrowings, borrowing and repaying bank loans, and other activities which could impact the company's long-term liabilities and equity. We now have an exercise for you. Identify the type of activity for the following questions. This could be operational, financial, or investment. Number 1. Run advertisements to attract new customers. Number 2. Hire fitness instructors to help the customers with their fitness workout. Number 3. Buy new fitness equipment to replace the worn out equipment. Number 4. Seek a short-term loan from ABC Bank. Number 5. Issue new shares to raise fresh capital for expansion. Number 6. Invest in a startup company working towards innovative fitness application. Number 7. Park your excess funds in a fixed deposit. And number 8. Buy a building for opening a new fitness center sometime in the future. You can now pause this video and make a note of your answers. So the answers are as follows. The first 3 are our operating activities. 4th and 5th are financing activities, whereas the last 3 are investing activities. Hope you got them right. Thank you. Hi, let's now look at the basics of financial statements. We start with understanding the meaning of accounting and its types. So what is accounting? Accounting is simply the process of identifying, measuring, and recording the business transactions, and then communicating the required information to interested users. Note that here the interested users refer to both external and internal users. Coming to the branches of accounting, we have 3 main. Starting with financial accounting, the purpose of this branch of accounting is to keep record of all the financial transactions so that 1. The profit earned or the loss sustained by the business during an accounting period can be worked out. 2. The financial position of the business as at the end of the accounting period can be ascertained. And 3. The financial information required by the management and other interested parties can be provided. Cost accounting. The purpose of cost accounting is to analyze the expenditure so as to ascertain the cost of various products that are manufactured by the firm. And then we use this information to fix the prices of the products. It also helps in controlling the costs and providing the necessary costing information to the management for their decision-making process. Lastly, we have management accounting. Now, the purpose of management accounting is to assist the management in taking rational policy decisions and then to evaluate the impact of these decisions and actions. Thank you. Hi, let's now look at the accounting standards. So, an accounting standard is a common set of principles, standards, and procedures that define the basis of financial accounting policies and practices. Now, this is done to maintain uniformity. Few standards, such as the International Financial Reporting Standards or IFRS and the Generally Accepted Accounting Principles, also known as GAAP, are internationally recognized, and few standards are country-specific. Thank you. Hi, let us now understand equity. Equity is a liability towards the shareholders and is termed as shareholders' funds. It comprises of share capital. Share capital means shares issued by the company for subscription and the amount received against the issued share capital, and also the shares issued for consideration other than cash. The persons to whom the shares are issued are known as shareholders. Share capital is simply the issuance of shares to the insider investors, that is the employees, and the outside investors, that is, the general public. Reserves and surplus. Reserves means the amount that is set aside out of the profits and surpluses to meet the future uncertainties. Reserve is created to meet prospective losses or liabilities, or even to strengthen the financial position of the company. It is also sometimes called as retained earnings. Money received against share warrants. Share warrants are the financial instruments which give the holder the right to acquire equity shares at a specified date and at a specified rate. These are financial instruments which will be converted into equity shares at a later date in a predetermined price. Share application money pending allotment. Amount received by the company towards the share application and against which it will certainly allot shares but paperwork is due is shown as share application money pending allotment. Thank you. Hi, let us now understand liabilities. Liabilities are obligations or debts that an enterprise has to pay at some time in the future. They represent creditors' claims on the firm's assets. Both small and big businesses find it necessary to borrow money at one time or the other and to purchase goods on credit. Liabilities can be classified as: Number 1. Current liabilities. Current liabilities are those liabilities which are expected to be paid within a year. The examples of such liabilities are bank overdraft, bills payable, sundry creditors, short-term borrowings, outstanding expenses, etc. Sundry creditors are those people to whom we owe money. Non-current liabilities. A non-current liability refers to the financial obligation in a company's balance sheet that are not expected to be paid within 1 year. Coming to the current liabilities types. We first start with short-term borrowings. These are due for payment within 12 months from the date of balance sheet. The items are: Number 1. Loans repayable on demand. When money owed is repayable on demand, it means that the lender can ask for the money back and it has to be handed over. Number 2. Bank overdraft. Number 3. Loans from other parties repayable within 12 months from the date of the loan. And number 4. Other loans and advances. Trade payables. Trade payables is defined as the amount payable against the purchase of goods or services taken in the normal course of business. It includes both sundry creditors and bills payable. Sundry creditors are those persons or entities to whom we owe money, whereas bills payable are such instruments which show the liability and the amount of debt. Thus, liability on account of a transaction which is not the normal business of the company is not shown as trade payables. For example, a trading company sells its fixed asset through an agent. The agent is to be paid $1,000 as a fee. The $1,000 will be shown as other current liabilities and not as trade payables, as they do not fall under the purchase of goods or services which is taken under the normal course of the business. Other current liabilities. Current liabilities that are not short-term borrowings or trade payables are shown under the other current liabilities in the balance sheet. These include: 1. Current maturities of long-term debts. It is the amount to be paid within 12 months of the date of balance sheet out of the long-term borrowings. It is similar to EMI or premium amount. 2. Interest accrued but not due on borrowings. It means interest is provided in the books of account, but it has not become due for payment yet. For example, interest is payable half-yearly in June and December. If the company closes its books on 31st March, it will record interest for the quarter January to March also. but the interest will become due for payment on 30th June along with the interest for the quarter April to June. Hence, the interest for the quarter January to March will be classified as interest accrued but not due. 3. Interest accrued and due on borrowings. It means interest is provided in books of account and is due for payment. In the above example, interest for half year June to December is provided in the books of account but has not been paid. It is interest accrued and due. 4. Income received in advance. Income received in advance means advance received by the company against which sale is yet to be and or services are yet to be rendered. Since the income has not been earned, that is, sales made or services rendered, it is shown as other current liabilities. And when it is earned, it is transferred to income. 5. Unpaid dividends. It means the dividends declared, but they remain unclaimed by the shareholders. Number 6. Outstanding expenses. Outstanding expenses are expenses that remain unpaid at the end of the year. Short-term provisions. Provision is the amount set aside to meet future liability, amount of which is not determined but estimated. Short-term provisions are provisions for liabilities which are likely to be paid within 12 months of the date of the balance sheet. Short-term provisions can be classified into 1. Provision for employees' benefits, 2. Provision for tax, and 3. Other provisions. Coming to non-current liabilities types. Long-term borrowings. Borrowings means amount taken as loan by the company. Whether a borrowing is long-term borrowing or short-term borrowing is determined on the date of borrowing. From the date of borrowing, because loan is a form of liability which involves interest, and we calculate this interest only from the date of when the loan was taken. Deferred tax liabilities. Every year, accounting income is compared with taxable income, and if the difference between the two exists, which is temporary in nature, income tax on the difference amount is termed as deferred tax. In case the tax paid is less than what it results in, then it would be deferred tax liability. Other long-term liabilities. Long-term liabilities other than the long-term borrowings are classified as other long-term liabilities under non-current liabilities. They are classified into 1. Trade payables. Trade payables are the amounts payable for goods purchased and services taken in the normal course of business. 2. Others, if they are payable after more than 12 months of the date of the balance sheet. Long-term provisions. Provision is the amount set aside to meet future liability, the amount of which cannot be determined with accuracy but are estimated. Long-term provisions are the provision against which the liability will arise after 12 months of the date of balance sheet. For example, provision made for retirement benefits payable to employees who will retire after 12 months from the date of balance sheet. So, to recap, we saw liabilities can be divided into current liabilities and non-current liabilities. Current liabilities can further be divided into short-term borrowings, trade payables, other current liabilities, and short-term provisions. Non-current liabilities, on the other hand, can also be divided into 4 parts. 1 is the long-term borrowings. 2 is the deferred tax liabilities. 3 is other long-term liabilities. And 4, long-term provisions. We now have an activity for you. Look at the items on your left and classify them under current assets, non-current assets, current liabilities, and non-current liabilities. You can pause the video to make a note of your answers. Let's now look at the solution. Machinery will be a part of your non-current assets, as we have not bought them for the purpose of sale but to increase the earnings of the business. Goodwill too, just like machinery, would fall under your non-current assets. But it's important to remember that this will be a part of your intangible assets. Sundry creditors will be a part of your current liabilities as you owe them money within 12 months. Cash at bank is the most liquid form of asset and so will fall under current assets. Bills payable will fall under your current liabilities just like sundry creditors. Land and building, which is a fixed asset, will fall under non-current assets just like machinery. Furniture too, just like land and building and machinery, will fall under non-current assets. Computer software, which is an intangible asset, just like goodwill, will fall under non-current assets as well. And motor vehicle, which is a fixed asset, will fall under non-current assets. Inventory will come under your current assets, just like cash at bank. Investments would fall under current assets and non-current assets depending on the time period, that is, if it's long-term or short-term. The same concept is also applied to loan from bank depending on the time period. Sundry debtors would fall under current assets. Patents, just like goodwill, will fall under your non-current assets. Air conditioner will fall under non-current assets just like every other fixed asset. Loose tools will fall under your inventory and so under current assets. Hope you got them right. Thank you. Hi, let's now discuss assets. So what are assets? Assets are owned or controlled by a business or an individual that provide a benefit in current and future periods for them. In other words, it's something that a company owns or controls and can use to generate profits today and in the future. Assets are also divided into non-current assets and current assets. Let's start with current assets. Current assets are those which are either in the form of cash or can be converted into cash within a year from a date of purchase. Examples include cash in hand or bank, accounts receivable, stock of raw materials, semi-finished goods, finished goods, sundry debtors, short-term investments, prepaid expenses, etc. Accounts receivable here denotes the money that we would be receiving in the near future and hence is a part of our current assets. Sundry debtors too represents the people who owe us money and so we will be receiving from them within a year. Prepaid expenses are the expenses that we have paid before the due date and so they are considered current assets up till the due date. Once the due date approaches, they become a part of our expenses. Coming to non-current assets. Non-current assets are a company's long-term investments that are not easily converted into cash or are not expected to become cash within an accounting year. Examples include fixed assets, long-term loans, etc. Let's start with current assets types. Current assets are those investments which are held to be converted into cash within 12 months from the date of purchase of investment. Cash and cash equivalents include number 1. Balance with banks, that is the money that you have kept with your bank. Number 2 are checks or drafts on hand. Number 3 is the cash in hand. Number 4 are others. Inventories or stock held for the purpose of trade in the ordinary course of business, that is, for manufacturing or trading of goods, are classified as current assets because they are held with the purpose to convert them into cash and cash equivalents within a short period. They can further be divided into 1. Raw materials, 2. Work in progress, 3. Finished goods, 4. Stock in trade, for the goods acquired for trading, 5. Stores and spares, for repairs, 6. Loose tools, etc. Trade receivables means the amount receivable for the sale of goods or services rendered by the company on credit to its customers in the normal course of business. They are shown as current assets if they are receivable within a period of 12 months from the date of balance sheet. Short-term loans and advances. Loans and advances which are expected to be received within 12 months from the date of balance sheet. It's important to note the difference between loans and borrowings. Borrowings are the amount that we have borrowed from others, and so they would be a part of our liability. Loans are the ones we give to others, and so are a part of our current assets. They can also be a part of our long-term assets or non-current assets. All other current assets that do not fall in any of the above classifications are shown as other current assets. Examples include prepaid expenses, because you have already paid but were not due, dividend receivable, advanced taxes that you have already done extra payment for, etc. Coming to non-current assets types. They are the opposite of current assets and are held for a period of more than 12 months. Fixed assets. Fixed assets are those assets which are held by a company not for the purpose of sale but for the purpose to increase earnings of the business. They are used for a long time to earn profit. They can be categorized into tangible assets. Tangible assets are the ones that have physical existence, that is, they can be seen and touched. Examples include land, building, machinery, furniture and fixtures, computers, vehicles, office equipment, etc. It's important to not confuse these with inventory, as inventory is for sale, but these aren't. Intangible assets are those which do not have a physical existence and thus cannot be seen and touched. Examples include computer software, copyrights, patents, database, goodwill, brands or trademarks, etc. So how do you determine the value of an intangible asset? Well, it depends on the type. If it is purchased, then it will be shown as the price that is paid by the company. But if it's self-generated, then it is determined after proper calculation. Basically, the amount will be determined by increase in profit in relation to the changes made in the business, and so are subjective. Next, we have capital work in progress. It means the tangible assets under construction. We also have intangible assets under development. Non-current investments. Non-current investments are the investments which are held not with the purpose to resell but to retain them. Non-current investments are further classified into trade investments and other investments. Trade investments are the investments made by the company in shares or debentures of another company to promote its own business. Other investments are those investments which are not trade investments, like investment in property, etc. Deferred tax assets. Every year, accounting income is compared with the taxable income, and if the difference between the two exists, which is temporary in nature, income tax on the difference amount is termed as deferred tax. In case you have paid more, then you will get it back, hence is an asset. Long-term loans and advances. Those loans and advances that are expected to be received back in cash or in kind, that is in the form of an asset after 12 months from the date of the balance sheet. Other non-current assets. All other non-current assets that do not fall into any of the above classifications are classified as other non-current assets. Let us now discuss depreciation or amortization. Fixed assets tend to reduce the value once they are put into use. Let's say a business enterprise procures a machinery and uses it for the production process. The value of the machine would decline with usage or the general wear and tear. Even if the machine is not used in the production process, we cannot expect to realize the same sales price due to the passage of time. It implies that fixed assets are a subject to decline in value, and this decline is technically referred to as depreciation. Let's take an example. A machine is purchased for $10,000 on 1st April 2019. The useful life of the machine is estimated to be 10 years. 10,000 is a capital expenditure during the year 2019 to 2020. However, when the income statement, that is the statement of P&L, is prepared, the entire amount of 10,000 cannot be charged against the revenue for the year. Because of the reason that the capital expenditure amounting to $10,000 is expected to derive benefits for 10 years and not just that year. Therefore, it would be logical to charge only a part of the total cost, that is, $1,000, 1/10 of 10,000, against the revenue for the year 2019 to 2020. This part represents the expired cost or the loss in the value of machine on account of its usage or the passage of time. And this is called as depreciation. Therefore, this is a charge against profit and is debited to the income statement or the statement of P&L. Amortization, on the other hand, refers to the writing off of the cost of intangible assets. These include patents, copyrights, trademarks, franchisees, goodwill, which will have utility for the specified period of time. So to recap, assets can be divided into current assets and non-current assets. Current assets are those which are held for a period of less than 12 months. Non-current assets are those which are held for a period of more than 12 months. Current assets can further be classified into cash and cash equivalents like cash in bank or cash in hand, inventories, that is the stock that we hold, trade receivables that we will be receiving shortly, short-term loans and advances that we have given to others, current investments that we hold, and other current assets that do not fall in any of the above categories. Similarly, the classification of non-current assets is as follows. We first have long-term loans and advances, non-current investment, deferred tax assets, fixed assets, and other non-current assets that do not fall in any of the other categories. Fixed assets can further be classified into tangible assets that we can feel and see and touch, intangible assets that we cannot see or touch. Capital work in progress are the tangible assets that are under development, and intangible assets under development. Thank you. Hi, we now aim to understand the balance sheet. Let's look at a few key terms. To recall, a balance sheet is a financial statement that provides the details of the company's assets and the sources of funds at a certain point of time. The examples of assets are machinery, inventory, etc. In the sources of funds, it can take from owner's money or as liabilities, which are obligations
insurance money to pay for the loss.